Greetings, everyone. Thanks for tuning in. We'll be talking today about the collapse of Silicon Valley Bank. My name is Aman Verjee. My full-time job is running a venture capital firm in the Bay Area. I live in Palo Alto, and we work right on Sand Hill Road. My part-time job is actually as a lecturer at Harvard Business School, where I teach in the Venture Accelerator there, HBS X and Y, and also talk a bit about Fed policy. And I know that's a weird Venn diagram, but it turns out last week something happened that affects both the tech venture ecosystem and the Fed in the Federal Deposit Insurance Corporation. So I've been asked to give this lecture series as part of the HBS course in Fed and monetary policy. And we've recorded about a 10-minute segment today, which will make you smarter than about 95% of people about what happened with Silicon Valley Bank, what's happening right now, and maybe most importantly for our tech startups and for many of you in the audience, what do I do with my money? What's going to happen next, and what do I do with my money? So that's the topic today. It'll be about a 10-minute series. So I'm going to cut over to some slides right now and walk you through a little bit of a background on Silicon Valley Bank, what happened and who they are. Many of you have heard about Silicon Valley Bank, but if you're not in the tech ecosystem, you'll know by now who they are. You probably don't have a good appreciation for why they failed. So first of all, they grew very, very quickly in 2021. As a bank, they had a very concentrated set of liabilities by geography and by industry, and we'll talk a bit more about that. And then they made some risk management mistakes, which we'll walk through, and it definitely has consequences for other banks in the space. So we should talk about how not to make those mistakes again. So first of all, on their growth, Silicon Valley Bank is about the 16th largest bank in the U.S. So many people outside of the Valley haven't heard about it. But it turns out that they bank 44% of the tech startups and venture-backed IPOs in 2022. So they're not systemically important in the way that Janet Yellen might use that term, but they were definitely important to the tech ecosystem in and around Silicon Valley. Most of their loans were out to venture capital firms and private equity-backed companies. You can see how quickly they grew their balance sheet on the left-hand side. They had a 40% CAGR between 2018 and 2022. Most of that growth happened in 2021, when a lot of their clients, those venture capital firms and venture-backed companies, took in a lot of money, right? We had a lot of fundraising records set and broken in 2021. What did those companies do with that cash? They put it in the bank. And Silicon Valley Bank was the primary banker to these tech startups. So the size of the bank exploded in the last couple of years. Most of the clientele in the Silicon Valley Bank ecosystem were either early-stage technology companies, they were early-stage tech venture capital companies, or they were the people who worked for those firms. So it had a high dependence on technology startups. That's just one thing to remember as we move forward. And they were also very heavily concentrated in the Bay Area. Most of their clients came from Northern California, in and around the San Francisco area. So a lot of geographic dependence, very, very much a tech startup type bank. The balance sheet is here on the page in front of you. They had $195 billion in liabilities on their balance sheet. We'll talk a bit about that in a second. But the important thing to note is that most of it was really deposits, and that they owed these deposits to tech companies, tech startup founders, and entrepreneurs. When you start thinking about a bank and what goes wrong, you always start with the balance sheet. So let's talk a bit about what is on the SVB balance sheet, or what was at Q4 2022 and what went wrong. Well, on the left-hand side of the balance sheet, you can see that they have three major components. They've got loans, they've got held-to-maturity securities and other assets for sale, and then they had a little bit of available for sale securities and cash. But the bulk of their assets are in things like loans and then held-to-market securities. It looks on the surface of it that they had more assets than liabilities, so that's the good news. They have about $17 billion more in assets than liabilities. So for a bank, that means your book value is the difference, $17 billion. So far, so good, right? So what's the problem? Well, let's just double click on each of these asset categories. The first one is their loan portfolio. When a bank takes in money from depositors, they make loans. They make loans for houses, to businesses, to individuals, and to families. Was there any problem with the loan book? In most situations, in most cases, when banks go under, it's some problem with their loans. People are not paying back their loans. They start missing payments. The loans go into default. That's what compromises the quality of the assets. And that's when the bank goes belly up. In this case, that is not what happened. I've coded the major loan categories here on the sheet in front of you. Green is like it's a performing loan, people paying their bills as far as we can tell. Yellow is they're kind of in trouble. Red might be somewhat distressed. In this case, there's a lot of green on the page. So the loans they had put out were largely performing. People were paying their bills. SVB wasn't missing any payments, didn't have anything of a default problem. So this is not like 2008 when we had a subprime mortgage default problem. It's not like the 1980s when we had savings and loans and people can pay their bills. It's not like the 1930s when people were defaulting on loans. That's not the issue that we had with Silicon Valley Bank. And it is interesting that in most cases when banks go under, it's a bank run that's caused by defaulting loans. I have my first question from our HBS team here is, what is a bank run? If you were born after 1942 or so, you've probably never seen a bank run, at least not in the United States. What you should do is go to YouTube, go look up this old movie, It's a Wonderful Life. Do yourself a favor, ignore the colorized version of It's a Wonderful Life. Just do the black and white version of It's a Wonderful Life and type in It's a Wonderful Life bank run scene, and you'll see this great 4-minute clip with Jimmy Stewart and Donna Reed, and you can see what a bank run looked like on movie. And you might remember that movie. You've probably seen it on NBC before. Basically what happens is there's a long line of people out the door, right, at the Bailey Building and Loan. Jimmy Stewart's there, Donna Reed is there. People are like clamoring for their money back, and they all want their money out of the bank. And Jimmy Stewart says, "I don't have your money." No, Charlie, you're thinking about this place all wrong, as if the money's back there in a safe. Well, the money's not in a safe. The money's in Joe's house, and it's in Abdul's startup, and it's in Brianna's Tech Life Sciences VC. Not exactly what Jamie Stewart says, but I'm paraphrasing a little bit. But that's basically what happened with Silicon Valley Bank. People began rushing to the bank saying, "Hey, where's my cash?" And basically the bank has to say, the money's not in a safe. We can pay you, but we have to get paid off of these loans first. Now, the good news for Silicon Valley Bank was they actually had a performing loan portfolio. So this is not a 1930-style bank run where people didn't have the ability to pay loans, and that created a liquidity crisis. The problem actually happened in a different category. It's this HTM securities category. And the first thing to note about it is it's $91 billion. Out of $212 billion in assets, $91 billion is sitting in held-to-market securities. Most of that is in treasury bonds and mortgage-backed securities, high-quality mortgage-backed securities. It's a big number, which is a bit odd for a bank, because the business of a bank is take money from depositors and put it out in loans. And those loans hopefully will get repaid with interest, and then you can pay back your depositors. In this case, though, the biggest asset category is not loans. It's these held-to-market securities. Why was Silicon Valley Bank sitting on such a big slug of securities, like mortgage-backed securities and treasury bonds? Well, they grew so fast, remember, in 2021 and 2020, that they just could not make loans fast enough to get rid of all the money. So what do they do with the money? They put it into what they thought were very safe securities, treasury bills, treasury securities. They wanted to get some additional yield, so they put it into mortgage-backed securities. This is not a problem as far as credit risk goes. People are right now in the U.S., they're paying their mortgages, they're paying their bills. The default rates on mortgages are near historical lows. So this wasn't the problem. The problem was one about duration, not about credit risk. And you might have studied this in bond math class, but this is a price index of what mortgage-backed securities look like in the U.S. And remember, they are very sensitive to interest rates. So when the Fed started raising interest rates in the middle of that curve, about early 2022 is when the Fed started raising interest rates, you can see what happened to that blue line. It basically falls off a cliff. The value of all these mortgage-backed securities and treasuries began to fall. Just the market value began to fall as interest rates went up. When interest rates go up, the price of a bond goes down. This is a basic lesson that somehow SVB didn't internalize or hedge against. In fact, in 2022, the bond market broadly had its worst year since we began tracking stuff back in 1754. The value of these bonds fell by 10, 15, 20%, which has never happened before in the history of the bond market going back 200 years in the U.S. and 350 years in the United Kingdom. So SVB every quarter had to report growing losses on their balance sheet. And it turns out that at the end of Q4, they said we have $15 billion in unrealized losses. Why are they unrealized? Well, the value of this bond portfolio has fallen by $15 billion. As a matter of accounting, you are supposed to report and declare what the unrealized losses are as if you were to market the value of these bonds. And that's what SVB did. They weren't hiding these losses. There's no obfuscation. Every quarter that went by as rates were climbing, they were reporting bigger and bigger losses. Finally, what happened was in Q4, the bank basically said, hey, we're going to have to raise some additional equity because our unrealized losses are now overwhelming our book value. And so they said to the market, we're going to go out and fundraise and raise, a couple billion, $3 billion, maybe sell some of these treasuries, try to raise capital to solidify our balance sheet. Well, in middle of February, that's when they did their annual report. And so this information was out in the market in the middle of February. But it turns out nobody really did anything with that information. Not the regulators, investors were talking and looking at it, but nothing really was done, and there was no critical event that triggered any additional action until about March 8th, Wednesday, March 8th. On Wednesday, March 8th, the bank did two things. They sold some of their securities at a loss and had to report those losses as now realized losses. That's not, all that terrible or all that interesting, just given that people knew this was inevitable. They also tried to raise $2.25 billion in the public markets. And they did the roadshow, and it turned out the roadshow didn't go well. The investors were not willing to invest in Silicon Valley Bank, at least not at the price that they were quoting. So the price of Silicon Valley Bank, the bank shares, had already fallen by 50% since late last year. They went down by another 60% almost overnight on March 8th when the roadshow failed. Then the second thing happened that really was not under SVB's control. This is just bad timing. Another bank went bankrupt in the U.S., Silvergate Bank, kind of a smaller bank, a crypto-focused bank. But it's just a tough time to be fundraising in general, and one of your bank competitors goes bankrupt. That's just a terrible time to be talking to investors. And then the third thing happened on Thursday, March 9th. The investors, the depositors rather, in Silicon Valley Bank, venture capital funds, companies, tech founders, they began to pull their money out of the bank. And in this respect, it sort of was like It's a Wonderful Life with all the people lined up outside of the door trying to get their money from Jimmy Stewart and Donna Reed and Uncle Billy. What actually happened, though, was VCs and tech founders were on Twitter. And they began communicating on Twitter. And they began saying, you know what, Silicon Valley Bank, shares are down. I'm not sure they can cover their deposits. Not sure their book value even looks positive right now. And they can't raise money. Just pull your money out. And all of it, at the speed of Twitter, $42 billion of the bank was attempted to withdraw on Thursday, March 9th. I don't think a modern bank has ever had that kind of a rapid withdrawal in history. That's like a third of their deposit book basically was trying to walk out the door on Thursday the 9th. And once that happened, the bank had to declare, and they couldn't cover the deposits, so they had to declare insolvency. And the Fed took them over the next day. So a little bit of a modern twist on the bank run is now stuff happens at the speed of Twitter, and you only have to go to the bank's website and do a wire transfer or withdrawal. You don't have to go to the bank anymore and present your information and wait in line. This all just overwhelmed the bank. So that, in a nutshell, is how Silicon Valley failed. I'll just say one other thing. They're not the only one facing this unrealized loss problem. It turns out that they are one of many banks that are suffering from this unrealized loss problem. As interest rates have gone up, the total value of the bonds that these banks are holding has gone down. The Fed, a couple of months ago, actually wrote this report saying there's $620 billion in unrealized losses in banks all over the U.S. 15 of that 620 was at Silicon Valley Bank, and that was enough to overwhelm Silicon Valley Bank. Now, the important thing is this is not hiding. The banks aren't hiding this information. It's actually published on their balance sheets. The regulators look at the stuff. I've heard a lot of questions about why didn't we know about this sooner. I can speculate a bit about why we didn't act on it sooner, but I can tell you that banks report unrealized losses. And here's a report that shows all the major banks in the U.S., and you can see the blue line is where their book values are, their common equity tier 1 capital ratios are, as a percent of their assets. And then those orange lines are, hey, what if I adjust this for the unrealized losses? And you can see there that SVB, by the end of Q4, almost was entirely wiped out. So they were the most sensitive to these unrealized losses of the major banks. But they're not the only ones. A few other banks are still struggling with this right now and have to figure out how to deal with it. Okay, so a couple of things on, what do we do next? One of the questions I've gotten from our team is, can the Fed just cover all of the uninsured depositors? And I think the short answer is it's really, really hard to imagine for me to imagine that the Fed will do this for one major reason. The Fed has stepped forward and said we're going to cover all the uninsured depositors at SVB and at Signature Bank, two of the banks that went down about 2 weeks ago. And they have secured a line of credit with the Federal Reserve of about $25 billion to do that. So they can do it for a couple of banks. There are trillions of dollars of uninsured deposits out there at all the regional banks. So you have to now imagine that for the government to pledge to secure all the uninsured deposits, it's a potentially multi-trillion-dollar liability. Even if the Fed wanted to do that, some history is relevant here. In 2009, during the last great financial crisis, there was a temporary order that the Federal Reserve put in place that said they would protect uninsured deposits for a period of time across all of these banks. But that was very politically unpopular at the time, or became politically unpopular at the time. And so the Fed cannot do that independently of a couple of things. They've got to work with the Secretary of Treasury, first of all, in consultation with the President. They have to declare the bank to be systemically important, which means it's so important to the U.S. financial system that it's essentially too big to fail. If the bank goes down, there's going to be consequences for other banks. And there's some discretion in how the Federal Reserve and how the President or the Secretary of Treasury, Janet Yellen, could do that. But they need 2/3 of the FDIC board to agree with that. So there are checks and balances in the U.S. government, and that's, part of why we're a great country, but also it hamstrings the Fed in terms of what they can do next. And in 2010, we passed another law called Dodd-Frank, and the additional restrictions that Dodd-Frank put on this systemically important restriction is that the Fed is actually prohibited from bailing out uninsured depositors until or unless the bank is in insolvency, which was true for SVB, it was true for Signature Bank, but they cannot proactively go out and do that with all the uninsured depositors everywhere in the U.S. So I wouldn't expect that to happen. Could it happen? Yes, but it would really require an act of Congress. And if you haven't been paying attention, Congress is now in the hands of a Republican Party, with only a 4-seat majority. So it's very, very thin. But this Republican Party doesn't seem to be in a position where they're going to put out trillions of dollars without having this administration cut an equal amount of spending. This group of Republicans in particular seems to be headed in a very different direction as far as fiscal discipline than where we've been in the last 2 years. So I wouldn't expect this to be something that Congress can easily agree to. Last question we'll address, and the other big question for all of our startups is what do I do with my money if the Fed is not going to bail out all these other banks, and we don't know what's going to happen next as far as are these banks in trouble or not? Is my bank in trouble? I'll tell you what I just tell all of our startups. You should open a couple of different bank accounts. If you have millions of dollars on deposit, just remember that the federal insurance guarantee is up to $250,000 per account per bank. So the smart thing to do, in my mind, is open up a couple of different bank accounts at a couple of different banks and keep your outstanding deposit balances below $250,000. And that way you're protected. No matter what happens next, you know that you're insured and you're protected. Why take any kind of a risk with your working capital? The second thing you should do, and maybe opening up multiple bank accounts and doing that at multiple banks is too much of an overhead and too much of a chore. The other thing you can do with your primary bank is explore what's called a cash sweep account. Some banks call it a money market sweep account. Some call it a cash sweep account. They all have got some version of this. What they do is they put the money in a special account, and every day, overnight, they put the money out to 3, 6, 10 FDIC-insured banks in small increments amounts. They sweep the money out, and they sweep it back in the next morning. So you never miss the cash, but the money is never, on these overnight accounts, it's never at risk of more than $250,000. It's usually something you have to go to talk to the bank about, activate that. The good news is you'll get some interest on it, and the money market funds are now yielding 3-4% in these overnight funds. So you're going to get real money on it, and you'll get FDIC insurance and protect yourself that way. The only downside really is it takes some additional effort to work with your bank to do it. But given what's happened at SVB, it seems like it's well worth it. Okay, that is the time. Thank you very much for listening. If you have any additional follow-up questions about this topic or others, you can see where we are. I'm at Aman at practicalvc.com. We are practicalventure.com. Thank you.